Two IPOs, both popped on day one. One went on to lose roughly 80% of its value. The other quintupled your money. Rivian opened up 29% in November 2021 and then fell more than 80% from its IPO price. Reddit popped 48% in March 2024 and then ran to nearly 5 times what it opened at. Same green candle, opposite endings. SpaceX just closed its first trading day up roughly 19%. If you are a self-directed investor between 35 and 55 watching that ticker, this is not a celebration problem. It is a signal problem. Because the crowd pointing at that pop and saying it proves something about SPCX 3 years from now is selling you a story the data has already refuted. Twice, with receipts. Today we're going to look at two companies that handed you the exact same green day one and then took you to completely different places. By the end, you will have a framework for what a pop actually measures and what it cannot measure at all. If you want one deep dive a week that respects the data and your time, subscribe to the Paycheck Lab. Now let us get into the ledger. Rivian went public on November 10, 2021. IPO price was $78 a share. When the Nasdaq opened that morning, the stock opened at $106.75. By close of business, it was sitting at roughly $100.73. That is a 29% gain over the IPO price in a single session. Analysts called it a blockbuster. The headline said Rivian was already worth as much as Ford and General Motors combined. Investors who got in at 78 were up nearly a third before lunch the next day. 6 days later, it hit $172. The hype was compressing years of upside into a week. Now picture the bar. Your $150 investment at the IPO price is a bar sitting at $150. 6 days after the IPO, that bar has climbed to $330. The crowd is watching the bar grow and calling it a franchise. Then the bar starts shrinking. It does not crash overnight. It grinds. The EV premium that the market priced in, the assumption that Rivian would scale production fast enough to justify a valuation bigger than century-old automakers, started colliding with the actual delivery numbers. In 2022, the bar fell below the IPO line. In 2023, it kept falling. By mid-2025, that original $150 had become roughly $25. That same $150 in an S&P 500 index fund over the same period grew to approximately $230. The gap between those two bars is $205. That is the cost of reading day one as a verdict on the franchise. Here is where the story splits. Reddit went public on March 21, 2024. IPO price was $34 a share on the New York Stock Exchange. It opened at $47. It hit an intraday high of $57.80 before settling to close at $50.44. That is a 48% gain on day one. Bigger than Rivian's pop in percentage terms, on a smaller, messier company with nearly 2 decades of consecutive losses on the books. The headlines were skeptical. Reddit had no clear path to profitability. The company's relationship with its own user base was famously volatile. This was, some analysts noted, the first social media IPO in 5 years. The mood was, interesting experiment, probably gets cut in half. You know what happened instead? Reddit closed at $270.71 on September 18, 2025. That is the all-time closing high. From the IPO price of $34, that is a gain of nearly 700% in 18 months. Even from today's price of around $173, that original $34 investment has grown to roughly 5 times its value. Now put those two bars side by side. Rivian day one plus 29%. Reddit day one plus 48%. If you use the size of the pop as a signal, you would have ranked Rivian above Reddit. The pop told you Rivian had more demand, more institutional conviction, more excitement. It told you nothing about whether the business could deliver. This is what I call the day one illusion. The pop is a real event. It reflects something. But what it reflects is not the quality of the franchise over the next 3 years. It reflects the gap between what the underwriters priced the deal at and what the market was willing to pay at 9:30 in the morning. That gap is about supply and demand for a small float of shares on a single day. It is a liquidity event dressed as a verdict. Let me show you the mechanism. When a company goes public, the underwriters, the big banks running the deal, set the IPO price the night before. They've spent weeks on the roadshow meeting institutional investors, building a book of demand. They want to price the deal high enough to raise maximum capital for the company. They also want to leave some upside for the institutions who bought in, so those institutions keep coming back for the next deal. That gap they intentionally leave is the pop. The pop is engineered. A 15 to 25% first-day gain is not an accident. It is closer to a fee paid to the institutional buyers for participating in the offering. What the pop tells you is that the underwriters priced the deal below what the market cleared at. That is it. It is information about the book-building process, not information about the company's ability to compound value over years. You might push back here and say, look at Reddit. The pop was massive and the stock kept running. Does that not prove the pop signal was right? It is the right objection, and it is worth addressing directly. Reddit's success after the IPO was not because it popped 48% on day one. It was because Reddit turned out to have a business model that the market kept revising upward. The AI data licensing deals, the ad revenue growth, the international user expansion, those fundamentals drove the stock from 50 to 270. The pop on March 21st was irrelevant to that trajectory. You could have bought Reddit at $50 the day after the pop, after missing the entire first day, and still made more than 4 times your money by September 2025. The pop did not predict that. The business predicted that. Now let us bring Jay Ritter into the room, because this is not just 2 data points. Ritter is a finance professor at the University of Florida who has spent his career studying IPOs. His 1991 paper in the Journal of Finance is the most cited study on this question, with over 60,000 citations. He looked at 1,526 IPOs from 1975 to 1984. His finding, in the 3 years after going public, IPOs returned 34.5% on average. A matched group of comparable companies that did not go public returned 61.9%. The gap is 27 percentage points. IPO buyers, measured from the first day close, underperformed by more than a quarter of their potential return. That underperformance was worst among companies that went public during hot markets, when everyone is excited, when the pop is biggest, when the narrative is loudest. Those are exactly the conditions under which the long-run math gets the ugliest. Rivian went public in November 2021. Do you remember what late 2021 felt like? Growth stocks were at all-time highs. SPACs were minting billionaires. EV was the most crowded thematic trade on the planet. Rivian raised $11.9 billion in the largest IPO of that year. The pop was huge. The Ritter pattern would have predicted, watch out, the crowd got there early. Reddit went public in March 2024. The IPO market had been effectively closed for 2 years. Valuations had reset. Reddit actually priced at a discount to its last private round, $34 a share versus a $10 billion private valuation from 2021. The market was not euphoric, it was cautious. The pop happened anyway, but the conditions were different. None of this is to say Reddit's outcome was predictable. It was not. The point is that the pop told you nothing either way. What mattered was the business. Here's how I want you to think about the architecture of day one. Picture a 2-stage diagram. On the left side, you have the IPO event, the roadshow, the book build, the pricing, the opening trade. This stage is about sentiment, supply constraints, and institutional positioning. The pop lives entirely in this stage. On the right side, you have the 3-year business reality, revenue growth, margin expansion, competitive moat, execution. The long-run stock price lives entirely in this stage. The problem is that we watch stage 1 obsessively and assume it tells us something about stage 2. It does not. Stage 1 is a sentiment measurement. Stage 2 is a business measurement. Those are different instruments reading different things. SpaceX closed yesterday at roughly 19%. That pop is real. It reflects genuine institutional demand for exposure to Starlink's recurring revenue, to Starship's optionality, to the Elon Musk premium. That demand is not made up. But whether SPCX trades at $80 or $800 in June 2029 will be determined by execution. Whether Starlink subscriber growth holds, whether the XAI integration adds value or destroys it, whether SpaceX can convert its launch monopoly into durable margin. The pop gives you zero information about any of those things. Someone who tells you the 19% open proves this is a generational hold is selling you narrative. Someone who tells you the 19% open is a red flag and you should wait for it to come back down is also selling you narrative. The honest answer is that day 1 is a liquidity event. It is when the private company becomes a public one. The market is meeting it for the first time. That meeting is exciting. It is also almost entirely noise. So what do you actually do with a new IPO you are considering? Step 1 is to ignore the first day price movement entirely, not partially, entirely. Do not look at the pop percentage as a positive or negative signal. It is not signal. It is the sound the market makes when it encounters something new. Look at the business. Read the S1. Understand where the revenue comes from, what the competitive mode is, whether the unit economics make sense. Step 2 is to wait for the lockup expiration. Most IPOs have a 90 to 180-day period where insiders and early investors cannot sell. When that window opens, you get the first real test of what the people who know the company best actually think it is worth. Heavy selling at lockup expiration is a data point. Continued holding is a data point. The first day pop is not. Step 3 is to measure it against a boring alternative. Before you buy any individual IPO, ask what that capital would earn in a broad index fund over the same period. Ritter's data says the average IPO underperforms comparable companies by 27 percentage points over 3 years. That is the base rate you are betting against. The burden of proof is on the IPO to show you why this one is different. A big day 1 pop is not evidence that it is different. It is evidence that the underwriters left money on the table for the institutional buyers. Here is the reframe I want you to carry out of this video. You do not actually want a big pop on an IPO you bought into. A huge pop means you got in at 34 and the market is now at 50 on day 1. But the company only captured $34 of that value. The extra $16 went to the institutions who flipped it in the opening hours. The pop is the return of the IPO buyer, not the company. When Rivian popped 29%, the investors who got the institutional allocation at 78 made 29% in a day. Rivian, the company, did not get that money. It already got 78 when the deal priced. The pop measures the premium the crowd paid above the deal price. That premium is not your friend if you are buying on the open market after the first bell. You are buying into the sentiment, not the business. Rivian and Reddit handed you the same green candle on day 1. One of them was the most overhyped EV company in recent memory, going public at the peak of a euphoric bull market. The other was a battered, loss-making social media company going public into a skeptical post-2022 reset. The pop told you Rivian was more exciting. The business told you Reddit was worth more. If you are a self-directed investor in your 30s, 40s, or 50s who makes these calls without an advisor, this distinction is worth real money. The pop is not the verdict. The business is the verdict. Give it 3 years to show you what it is. Drop a comment with what you think SpaceX looks like in 2029. Not the pop, the business. Revenue, margin, subscriber count, that is the real conversation. I will see you in the next one.